Hey guys, what is up? It's Arunat here. Today we're talking dividend investing because Balash, one of the subscribers, requested this topic under the previous video. Thank you for the comment, mate. I really appreciate it. So we're going to talk about how to make some passive income and what goes into dividend investing. We're going to talk about what is a dividend, why companies issue a dividend, what are some of the pros and cons of investing focusing on dividends, and how you can find those awesome companies who are reliable and a good candidate when it comes to dividend investing, so you can enjoy not only passive income but growing passive income for many years and decades to come. Okay, before we dive deeper into this, I would really appreciate if you could drop a quick like on this video, and although it's just a single click of a button, it helps out tremendously with the YouTube algorithm and to show this video to more people. So if you could help in that, I would really appreciate it. Thank you, and with that said, enjoy the rest of the video. So first of all, what is a dividend? It's nothing difficult really, it's just a way to distribute a company's profits to its owners, also called shareholders, just like you and me, if we decide to buy some shares. And I think that is a critical point with new investors out there, because oftentimes I feel like they're just buying the ticker symbol, the few letters with the associated stock price, when in fact you're buying way more than that. You are becoming an owner of an actual business. And when you're becoming an owner of a business, it's not a bad idea to look at their numbers just to see how well they are doing and how sustainable that is. And that's exactly what we're going to do later in this video. Whenever you look up a company's dividends, you will see a flat dollar amount. That's how much dividend they pay every year. You have to divide that by how many times they pay every year, so you will get what are the actual dividend payouts. Now, if a company pays dividend, they usually do it every quarter, but there are companies who do it every month or 2 times a year or even just once a year. But not all companies pay a dividend. That's when you will see a 0% or a $0 dividend when you look up their data online. And that is because there are more tax efficient ways of giving back to investors. By the way, buying back shares is a great way of giving investors back, and is something a lot of people don't really pay attention to, but that's a different topic for another day. But it's more tax efficient, so paying dividends is not the first thing a company will do. And that's why you will not see young companies pay dividends, except for REITs or real estate investment trusts, because they are required to pay out a portion of their profits. So a company will start issuing dividends when it has grown to a big enough size that it has so much free cash flow, meaning that it has so much cash in their bank account that they don't really know what to do with, and next to reinvesting in the business, paying down debt, making acquisitions, and buying back shares, they will just start also issuing dividends to give back to investors. Now, they don't necessarily do all the 5 things with their free cash flow, but they can choose whichever they would like to do and to what extent, and that's something we will be interested going forward in the video. Okay, so now we know all that, but let's talk about why would someone invest for dividends? Let's talk about some of the pros and cons of dividend investing. First, some cons. As I mentioned earlier, it's not the most tax efficient way of creating value because the money is likely going through multiple taxation steps. Another drawback could be the time factor, because dividend investing is played on longer terms. You can't just hold a stock for 1 month because likely you're not even getting your first dividend payout. But this could also be a positive, because if you're focusing on the long term and once you are confident that you pick the right companies that are reliable and will likely do well in the future, you start to anticipate the dividend payouts way more than what the actual stock price is doing, and you're still getting paid no matter what. If the stock market would go flat for the next 5 years, you would still get your dividend payouts, while other people who are betting on stock prices are not really going to see any progress at all. So for these reasons, it can also give you a peace of mind, because regardless of what you do and what you spend your time with, you're still getting paid to do it in a way, and that's just the beauty of passive income, really. If you take how much I earn from dividends every year, I'm earning somewhere around a month's worth of minimum wage here. Essentially every year I don't have to work a full month if I don't want to, because I'm still getting paid enough to get by if that's something I want to do. So imagine having 30 days where you can just say no to anybody, because you can go hike, you can go watch movies, you can go to the beach, you can travel, and you're getting paid to do it. And I think that is a big luxury in today's world. But I would just likely end up working because I love working. I'm just like kind of a weird human, so it is what it is. But I believe dividends are the quickest and easiest way of getting started and building your passive income streams. And would you believe your age has a huge role in how you approach it? That's because if you're young, you have a lot of time in front of you to grow this thing into something even bigger for you. And you would do that by doing the following. Whenever the company pays you money in dividends, you do not spend it, but you use the dividends to buy more shares of the same company. Now you have more shares, meaning that you will receive a larger dividend payout next time, which you use again to buy more shares, and you repeat this cycle, growing your shares to larger and larger quantities and receiving bigger and bigger payouts. Now, this process will be enlarged by the fact that good, reliable companies tend to increase their dividend payouts over time. So it's not only you who gets more shares, but the shares are paying you more dividends as well. So it just gets bigger and bigger every time you repeat it. This snowball effect is something that got me started in investments, and something that I touched upon in my previous video where I explained step by step how I will grow saving just $1 every single day into $1 million. It's a pretty interesting thought experiment and something that is worth checking out because it's really eye-opening, so it's definitely worth a watch. Go ahead and check it out after this video. On the other hand, if you are of older age and perhaps looking to supplement your retirement income, you would look for companies that use their free cash flow, their cash in their bank account, to pay a higher dividend, meaning that it's going to be a higher dividend yield, but it's not going to grow as much as some companies paying a smaller dividend, but using the extra money to grow that dividend every year. But that's not a problem, because if you're looking to supplement your retirement income, dividend that starts high and grows very little is probably worth you more than something that starts very low and grows into something enormous in 50 years' time. I say that's enough theoretical stuff. Let's do something practical and show you how you can exactly find these companies that are reliable, will pay you the dividends no matter what, and will likely increase their dividends going forward. For that, we're going to jump to my other desk with my computer because that's way more convenient than this old, slow, loud laptop. So let's look up some actual companies, shall we? Now, obviously, there are lots of things that we could have a look at that make a company and the business sustainable and reliable. But for the purpose of this video, we're just going to look at things closely connected to dividend investing. I plan to do a whole series on things to look for when investing in companies, and even a course at some point in the future that goes way more in depth, because there is no need there to satisfy the YouTube algorithm. So if you would like to see that, make sure to comment down below. I would love a course, and I will make sure to invite the first 50 of you completely for free so you can check it out. Okay, but let's get started. I got a couple tabs opened right here, and the first thing we gotta talk about is that dividends are not guaranteed. That's something a lot of beginners do not know yet. So your best bet of finding companies with sustainable, reliable dividend and a great track record of paying them is probably to look up the list called the Dividend Aristocrats. Now, these are companies that are among the 500 biggest US companies and who have been increasing their dividends or keeping up their dividends for at least straight 25 years, which is a great feat. To find that list, you can go to dividend.com or any other site, and you're just gonna go to best dividends, and you're gonna look at Dividend Aristocrats towards the right. You click that, you get a list of these Dividend Aristocrats. We're gonna sort by dividend growth streak. Let's choose a company and I'll show you what I look for specifically concerning dividends. For the purpose of this video, let's go with P&G, Procter & Gamble, ticker symbol PG. It's a classic. I already got some tabs opened, so let's see what we got. Now, the first thing we can talk about is what's called a dividend yield trap. If you see this percentage number, it's relatively low in line with the average of the market. But sometimes you will come across crazy numbers, not among the dividend aristocrats, but you can sometimes see 10, 11, 14% crazy dividend yields. And what you want to make sure is that it's not a yield trap. And that usually happens whenever a company pays out either way too much of their free cash flow, even more than they have, which means they either paid out from that, which is horrible, you do not want to do that, or their stock price has recently plummeted, which artificially drives up the dividend yield. So make sure you check what the stock price has been doing lately. If it hasn't been falling, that's good. But if it's on a downtrend, that's not good, and it makes the dividend yield seem higher than what it actually was before. So just make sure to pay attention to that. Now, I like to see at least a 2% dividend yield, just so there is a good baseline of where we are starting our investment and from where we can grow with the company in the coming years. And another thing connected to that is how much that dividend has been growing, something that dividend.com gives you a hint at here. But I also like to go over to the NASDAQ site, which gives you a list of all the dividend payouts that have happened. And you can just calculate, simply divide this number by this number, and you will get what's the percentage increase they did. And going back a couple years, I have seen dividend increases from 3 to 10% year over year. And that's good because you would at least want 3 to 4% dividend growth every year if possible, because that means you're at least keeping up with inflation, and that's very important. So you're actually growing your money and inflation doesn't eat your money away. And the last piece of information I want to give you is something that I think is very important, yet very few people talk about it. It's called payout ratio. And it basically tells you of the money the company has, how much of a percentage they use that to pay out dividends. To check that payout ratio number, you can go to a website like Yahoo Finance, where you can type in the ticker symbol in the top search bar. You would come to the summary after selecting the company. You can go to the profile and read what the company is doing. You're more than welcome to do that. You should read a lot about what the company is doing just so you can understand the business better. But if you go to statistics, now if you scroll down, you will see payout ratio, and P&G pays out about 59%, which I think is just fine. Ideally, you would want a payout ratio that's less than 60 or 70%, because that means the company still has money left over to do with any kind of hardship that comes up, and they don't have to go to your dividend and cut it in half, because that would be the easiest thing to do. But if you choose from the list of dividend aristocrats, that's not what they after. They want to give you those safe and reliable dividends. And I think P&G's payout ratio is solid. Some people consider 70% to be the threshold below which your dividend is safe. So the lower this payout ratio is, the better it is. If you can maintain a high dividend yield with a high dividend growth, more importantly, the better it is. As I said, I would start from at least 2% dividend yield just to make sure that those dividend increases are actually taking me somewhere. So that's my take on the important factors that go into dividend investing. And now let's get back to the other table. That's it for today. I hope you learned something new today. I really tried my best to bring you as much value as I can in one video. So if you could let me know in the comments down below what was new information for you, or what kind of new videos you would like to see, just like Balázs did, I would really appreciate that. And once you are there, don't forget to leave a like on this video and consider subscribing and following me on Instagram and Twitter at Mr. Artur Nagy. I also have a Patreon where you can support the channel, ask your questions directly, get updates on my stock picks and dividend portfolio, as well as some great discounts, so you're more than welcome to check it out. That's everything I got for you. Happy investing, and as always, thank you guys so much for watching, and until next time.